Good morning, colleagues and friends, wherever you are. And today we will again go through the standard discussion with regard to the MPC meeting that took place yesterday. You've already seen, I'm sure, the press release that was issued yesterday evening. So I'll not cover the things, I'll not duplicate the things that are there, but to give you a sense of the background, and indeed also towards the end of the presentation also cover some of the things that maybe are forefront of your mind. A month ago, the MPC met, and at that time, the data that had been released confirmed that the global economy was in recession, and it was expected at that time to contract by an unprecedented 3% in 2020. Now, since then, we have seen more data, actuals, for Q1, the first quarter. And this is mainly for the OECD countries. And they confirm significant contraction in quarter one of 2020. We already had seen the number for the US at minus 4.8. The Euro area minus 3.8, UK minus 2, Germany minus 2.3, France minus 5.8, China minus 6.8. These are large and shocking numbers. Now, on top of that, Q2, second quarter, is likely to be worse. And that is because that is when there are more stringent containment measures in those economies. So, in a sense, this confirms the very dire situation that is there in the global economy. Now, at the same time, we welcome the stimulus or stabilization measures that have been put in place by the various authorities around the world. Now, coming closer home, last month we mentioned the newly released GDP data for 2019, and also at that time we also talked about our projection for 2020. And the number for 2019, the economy grew by 5.4%. This is, I'm repeating numbers that we talked about a month ago, 5.4% in 2019, and that was relative to 6.3 in 2018. And at that time, we forecast a growth of 2.3% in 2020 and 6.4% in 2021. Those are the numbers we communicated last month. And at that point, we also underscored that these projections are highly uncertain, unusually uncertain. Now, we have had some new data, but these data are really on leading indicators. We do not yet have the first quarter numbers for 2020, that is for us here in Kenya. We expect that in a few weeks. But I think the point would want to emphasize is the new data of the leading indicators in Q1 of 2020, things like, for instance, electricity consumption of petrol and diesel, importation of intermediate goods, etc. All this show that Q1 was relatively strong. So there is a bit of a bifurcation between what is happening in the global economy and what is happening in our Kenyan economy, the domestic economy. However, the indicators for April, that is for our economy, are mixed. There are, for instance, the transport on SGR, in terms of volumes, number of people and all that obviously has come down dramatically. And as you can imagine, this is obviously as a consequence of the lockdown, partial lockdown, and cessation of movement out of the various counties, Mombasa and indeed Nairobi and other counties. And other numbers such as excess duty, also that has come down, which really means consumption isn't taking place. And you can imagine the various products that attract excess duty. And also tourist arrivals have really declined to nothing in April. Obviously in March they came down dramatically, and complete shutdown really in April. Hotel bookings also have fallen, have come down to have really fallen. And on the back of all this, of course, you also have the news about agriculture. Agriculture is chugging along, and that obviously is being will be impacted by the rains and the weather conditions, and indeed some of the transportation issues that they may be having from the farms, let's say from the farm gate to the various markets where these things are sold. Indeed, also the containment measures. So in a sense, we have mixed bag, but I think it is important to appreciate that there's a bit of a bifurcation between the advanced economies and ourselves. That said, we have not revised our forecast for 2020. We have kept it the same as it was in April, and we will do this as soon as we have the actual Q1 data, which will be in a few weeks. Another thing that the MPC considered was obviously the economic stimulus program that was announced just last Saturday. It's interesting that the focus of this stimulus program is to cushion the vulnerable citizens and businesses, and also to enhance economic activity. So in a sense, to have a safety net for those vulnerable citizens and their businesses. It has actually targeted the critical sectors, and from the perspective of jobs. So employment, that is key. Wages, that is really the focus. It is also interesting that the economic stimulus package or program has in its sights also the MSMEs, the micro, small and medium-sized enterprises, of which we have said before, this is the backbone of our economy. So in a sense, targeted, and therefore less likely to, or rather more likely to be effective, and targeting the critical sectors. We as MPC looked at this and realized and appreciated, or should we say judged, that it has a high chance of success, and its expeditious implementation will be supportive of the economy. So those are the general points in terms of how the MPC saw the development of the economy, or the current structure, the conjuncture of our economy. In terms of the external sector, the exports for January to April 2020, this improved by about 5% compared to a similar period in 2019. Now, tea grew by 15.8%. That's huge, both because of higher volumes and favorable prices. The higher volumes, I think those relate to the weather conditions and things like that. Now, horticultural exports, however, fell by 7.5%, but within horticulture, there's a lot of sort of dynamics, different dynamics of the components. So I'll mention some of this and move on. I think the first thing to mention here is about flowers, which is obviously a significant element of horticulture. And the prices improved in March and April. Obviously, volumes were much lower, particularly in April. We all know that there was the, let's say, lack of cargo flights, and those have been put in place. And so that is expected to grow. As a matter of fact, more generally, in May, volumes of horticultural exports in the first half of May was 63% of total volumes in May of 2019. So more than half. So you can see that they are coming back. And obviously all these exports are being by air. Exports during the same period, the first half of May, were, in volume terms, 90%. 90% of the exports, flour exports, in May of 2019. And in value terms, there were 87.5% of the flour exports in May of 2019. You can already see that these numbers show that there is sort of a return to normalcy in particular, let's say, sectors. And I think horticultural exports is one such sector. We should also say that this is on the back of various government policies or various policies, and indeed negotiation and approval, and indeed implementation of more cargo spaces or more cargo flights. Also the cessation of constraints that were, let's say, constraining exports, particularly flour exports in the main auction in the Netherlands. So you can see those are coming back in place. On remittances, we have numbers for April that was mentioned in the press release, but I think I want to mention it separately. This declined by 9% in April relative to March. But interestingly, remittances from the US, which is our main source, have held steady. And obviously, we expect that the containment measures, lockdown and other measures that have been imposed that were imposed in the advanced economies would continue to affect or to constrain the transfers of or remittances back to Kenya by the diaspora, the Kenyans that are abroad. But I think the point here is that as those economies reopen, we would expect that there will be a return to more normalcy as well in those sectors. Just for you to note, for the year 2020, we are projecting a decline in remittances of 12%, about 12% in US dollar terms. Another point to mention, to flag to you, is that we have been receiving significant official capital inflows. And we have mentioned this in other discussions. For instance, the IMF, emergency support, the RCF, we received the equivalent of 730 million US dollars. The World Bank just recently, a week ago, approved support, DPO support. It's in two tranches, 750 million US dollars, and also another 250 million, so totaling 1 billion US dollars that was approved and is disbursing. The 750 has been disbursed, and the 250 we expect it shortly. Also last Thursday, the World Bank approved a credit, IDA credit of 43 million US dollars. This is to support the fight against the locusts. And also last Friday, the African Development Bank approved a loan of the euro 188 million. All this to support the government's efforts related to the pandemic. So you can see we have received a lot of or some official capital inflows, which will be supportive of those specific efforts in terms of budgetary support, and also will be supportive in terms of the foreign exchange market. So we will have ample reserves consequently. But I think another element which we need to flag is that the approvals and indeed the disbursements, they are a vote of, is a positive, is an approval of how the economy, meaning in terms of how the economy is being managed, and indeed in terms of the prospects of the economy. So in that sense, they are putting their money where their mouth is. And in a sense, it is a vote of approval, it's a positive vote on how the economy is being managed, and also how the medium-term and long-term prospects of the economy. Bottom line in the external sector is the current account deficit. We project it to remain around 5.8% of GDP, so no change really in this. And reserves, as we said, will remain adequate given all the various explanations I mentioned. There are some things I didn't want to belabor, like the price of oil and things like that, but I think all that is put together, we get the current account deficit that I mentioned. Moving on, I'll say a few things about the banking sector. And I think this has been, the news from the banking sector, I think, are good news in terms of they have remained operational throughout this period. And not just operational, they've been protecting their staff and clients. And this is important because first, banks signal that the economy is working. The economy continues to work. There is a very strong signaling effect from banks remaining open. And at the same time, they have done this protecting their staff and the clients. And as I said before, we had indicated to them some of the measures they needed to put in place so as to protect their staff and also protect their clients. And even as all this is happening, and the various containment measures are in place, they have operated at all places. As a matter of fact, a good example is when there was this sort of lockdown in Eastleigh here in Nairobi, and also Old Town in Mombasa, banks continue to operate. Particularly here in Eastleigh, there are 9 bank branches, and they have continued to operate even in the context of the lockdown. So I think, obviously, with the enhanced measures and all that. So I think the point we are making here is that that is an important signal of the economy remaining operational. Now, in terms of numbers, it's good to say, I would again say that the banks remain resilient, they remain strong, but the numbers indicate that. It's true, NPLs to gross loans have increased to 13.1%, mainly in real estate, trade, and manufacturing. But these loans actually were already on watch on March 1, 2020. So they were already on watch, and in a sense, they kind of moved, they then got classified correctly, meaning these were not things that were current at the beginning of March. Now, they have obviously been hit by various factors before, and maybe the COVID situation has worsened their situation. Secondly, the loans that were performing on March 2nd, there has been a lot of rescheduling that has taken place over the last 6 weeks. And on personal loans, something like 102.5 billion have been restructured. And this is something like 13.1% of the personal and household loans, the portfolio of personal and household loans. Other sectors, there's something like 170 billion that have been restructured. And totaling in all this, you have 273 billion that have been restructured. And this is about almost 9.5% of the total loan book. The total loan book is about 2.8 trillion Kenya shillings. Now, this is only in the first 6 weeks, and we know there has been an acceleration in the current month of May. But I think the point here is, again, we urge the those that have been affected by this pandemic to go and visit their banks, have a conversation with your banker and explain to them, maybe bring your pay slip, and also bring the letter that you had, maybe that sent you home, or laid you off, or those letters that actually indicate your specific situation. You do have, for instance, shops that the number of clients have come down dramatically, like malls, as you know, and they too have had that conversation with their bankers, which has helped them also transmit the benefits to their clients, or should we say their tenants. So it is important again to underscore the need to deal with this in a systematic and I would say organized fashion. So those are the important points in terms of the decisions that the MPC made. So as was indicated in the press release, it was clear that the measures that were put in place at the beginning, including obviously the reduction in CRR and all the other measures, was still working, and the reduction in the CBR was still working themselves through the system. And there was going to be the economic stimulus program that is going to be put in place shortly. So on balance, they assessed that the stance of monetary policy was the correct one, and we needed to see those other measures and see what is it that their impact, how is it that they're going to support the economy, and then advise accordingly, or let's say take actions accordingly. In the interim, of course, we will maintain our stance in terms of watchful gaze on the economy, monitoring developments in all areas. That's all I wanted to say in terms of the specifics, but now I have a few items which may be of interest to you, so I'll just go through them and we'll see whether these are of interest to you. I want to go back to a point I mentioned earlier about the SMEs. And this was one of the points of focus of the economic stimulus program, and wanted to underscore the urgency of dealing with that, and in fact the urgency of putting in place the credit guarantee schemes. And the urgency is clear to us. We are close to some of this sector, some of the operators in this sector, so we understand it. We, in a sense, have a pulse on that part of the economy. And suffices to say that SMEs, MSMEs as well, don't have a lot of, let's say, buffers in terms of credit or in terms of other resources that they can use. And therefore, they generally would die quickly. So they are very vulnerable in that sense. And as a matter of fact, there was a survey that was done at the end of April, and that survey indicated that three quarters of SMEs, of the surveyed SMEs, do not have cash beyond 2 months. So that means by end June, this three quarters of SMEs would be, they're on the ropes. They'll be gone because they don't have any cash to keep the lights on, to pay for even, all the things, that supplies, if they have to get supplies, or even to pay for their own workers themselves. So that is how critical the SME issue is. Now, it's not just financing. The SME situation is not just an issue of throwing money at SMEs. It's also an issue, it is finance plus. It's an issue of also providing them with appropriate solutions for their problems. For instance, products, demand for products. Now, it's true, we know some of the SMEs have switched to making the PPEs, the personal protection equipment that the masks and other things like this. But it is important for whatever action is taken place, whatever policy action that is taken place, that will be put in place, to be focused not just on finance, but also on the other side of it, which is the plus side, which is the products and things like that, so that the SMEs can actually produce for particular markets. It's that sort of connection that we want to underscore. So that's the reason for the urgency of the credit guarantee schemes. Because if we don't have one quickly, as I say, the matter is dire and it will only get worse. There won't be a solution and it will get worse. That's one point I wanted to make. On other points, there are some concerns by some of you, I think, about so-called IFRS 9 and how does this relate to what the policies that we, or let's say the measures that we recommended to banks and banks are undertaking in terms of restructuring loans and things like that. I think that is a much more technical issue. And I think it is fine to raise it in technical sort of, in a technical way. But I want to make a few points on this. It is true we have looked at this thing. And it is important to understand that, yes, we do not want, what we cannot do is to allow this to become sort of a critical issue that indicates that there will be significant increase in credit risk of specific borrowers and things like that. So we have, soon after we made our announcement, the BIS, actually sometime in mid-April, did issue its guidance as well, which is completely consistent with ours. And indeed, we are talking to ISPAC. These are the ones that are close to the auditors, so that there is a guidance note on the application of a uniform approach. It is true some of you have been concerned that there may be a haphazard, non-uniform approach, and therefore this is why it is important to work with those particular institutions that are charged with that responsibility, but explaining to them how is it that this would or could or should take place. From our perspective, these are exceptional times. This is highly exceptional and unusual circumstances that we face. And in the circumstances, and it is not the individual borrower's credit risk that has changed. As a matter of fact, providing that temporary relief would oils during that, let's say, gap period, when the economy reopens, the borrower continues. I mean, if everything is as before, then credit risk wouldn't have been changed, wouldn't have in any way been altered. The point, of course, is that the banks need to assess that well, so that it's clear that they are not penalizing themselves, nor are they penalizing the borrower. So I want to leave it there. I want to make it clear that it is not a mechanical sort of issue. It cannot be done mechanically, as most of you understand. But I think the point here is not to worry about it, because we are working with the various entities and following the general, let's say, approach that other institutions, meaning regulators such as ourselves, are doing in their own jurisdictions.